So we fell about 4 to 5% before today's bounce from the recent highs. How much would the broad indices, we'll get to your stock picks in a moment, how much would the broad indices have to fall for them to look cheap to you?
Well, the multiple right now, based on even 185.90 and bottom-up earnings, is still a 22 PE. But the offset to that is, yes, it's high by historical standards, but interest rates were never this low. You know, you have the 10-year right now closing at 1.65%. So we're sort of in uncharted territories. But as you know, Wilfred, we're bottom-up stock selectors. We don't buy the market or the ETF. I mean, the NASDAQ itself is very expensive. It's 39 times trailing and almost 30 times forward earnings. What's interesting is that about 6 months ago, the 2,000 and 2,500 were much cheaper. Today, they're more expensive than large caps, or roughly the 24 PE. So most of the bargains have disappeared in the small and mid cap.
What about those big cap tech stocks that do have genuine earnings and have really kind of grown into themselves in recent years, but have been affected by this recent pullback of the FANG names, the Microsofts of this world? If you had to pick one of them, which would it be?
Well, we've owned Apple since it was a value multiple, so I would continue to own Apple. They have, well over $100 billion in cash on the balance sheet. It's bulletproof. It's a great franchise. It's not cheap. Even if you back out the net cash, I still think it's about 27, 28 times earnings. What's interesting, we own most of the semiconductor capital stocks, AMAT, Lam Research, MKS, KLA. They're going to have great earnings acceleration over this year and next year as wafer spend has gone way up. But they're all somewhere between 17 and 20 times this year's calendar earnings. We normally buy things under 14. We continue to hold them, but they're very good franchises, and they're below market multiple at this point.
I want to get to some of your picks, Scott, and I think one is a home builder, which I always find interesting because you do pick home builders, but they have had such a tremendous run-up already amid the boom in the housing market. So why would you go there for a value pick?
Well, we've owned Horton and Lennar for a long time. We've also owned MI Homes. But this company has done a great job. The stock closed today. It was up nicely. It was $67, but they're going to earn between $10.75 and $11 this year. It's a 6 PE. It's ridiculous. The company generated over $75 million in the first quarter in free cash flow. They earned last year 22% return on equity on an annualized run rate. They're earning 25% return on equity. It's only 1.4 times book on a deleveraged balance sheet. And they're going to sell roughly 8,100 homes. They're mostly in the Midwest, where they have a very good position, and also in the Sun Belt. But they're the top three in lots of markets like Columbus, Ohio, Cincinnati, Chicago, Detroit, and even in Florida and Tampa. And it's a well-run company. And of course, the question is, what happens? Input costs like lumber have gone up, but they've been able to pass it through. The average price of their house is about $430,000 in backlog, slightly up from about $400,000. And the typical customer is either a first-time buyer or a move-up buyer. And actually, the cancellation rate has still been very low, only about 7 or 8%. That's people who sign the purchase and sales but aren't able to get financing. But as you know, interest rates, mortgage rates, the conventional today closed at 305, which is an APR of 3.27%. By historic numbers in the post-war era, this is very, very low, and it makes affordability much better for the average citizen.
Shepard Smith here. Thanks for watching CNBC on YouTube.